Views expressed by Camaplan podcast guests may not reflect those of Camaplan. Camaplan does not guarantee the accuracy of information provided by guests, nor does it endorse or recommend any individual or organization. Camaplan is not an investment advisor, CPA, realtor, or attorney. You are encouraged to conduct your own due diligence before making investment choices. For any tax, legal, accounting, investment, or other questions, please consult a specialist. Hi, I'm Michael Duncan, and welcome back to The Road to Financial Freedom. This podcast is brought to you by Camaplan, a self-directed IRA administrator focused on educating investors on how to grow retirement savings faster through alternative investments. In each episode, we're going to take an in-depth look at the many roads taken to financial freedom and how they differ for each of our guests. Our goal is to help the listeners learn how they can achieve their own financial freedom through the experience and stories of experts that have done just that. Today's guest is the co-founder of SP Venture Partners, which is a real estate investment firm that focuses on making real estate investments on behalf of family offices and UHNW families. I'm very excited to welcome Peter Powers to the show. Peter, how are you doing today?
Michael, I'm doing well. In ultra high net worth families. That's what so family offices, ultra high net worth families. And as of recently, we're even working with high net worth accredited investors.
Awesome. Yeah, and I'm very excited to delve into that a little bit more. I definitely should have just said ultra high net worth families. It is early here for me. I don't know. Are you on the East Coast as well?
Yeah, I'm based in Tampa Bay.
Yeah, so I am not a morning person. You seem like you're more awake than I am, but my brain does not normally start working until noon, which is not great for being in an office at 8:30, but that's what it is. Yeah, I would love to just start by kind of getting into how this all started for you, the start of this journey that you've been on to become the co-founder of this SP Venture Partners.
Yeah. So the start of the journey was really, I went to Florida State University. In the middle of my tenure there, I made a pivot from going down the path of becoming a surgeon like my father and one of my uncles to switching to become an investor. And, I was doing very well in school. I, got a pretty generous push from my family to, the healthcare business, that my family had built up was not the best next chapter for the overall family. And that it'd be better to focus on something with a little bit, better legs, you can have a better lifestyle. And that's what got me into the real estate space. And I started with, through a slew of internships. I did about half a dozen internships across the country. It's been 3 months. I was 3 months in Arizona, 3 months in different parts of Florida, North Carolina, really all over. I spent time with different owner operators, different property management firms, a bank up in Tallahassee, just to really understand kind of their perspective, their involvement in the commercial real estate space. I had an inkling that I wanted to start in the multifamily side. So I really started on the management, got to understand some of the lending with the bank out of Tallahassee. And then I started working with a few different property management owner operators, one based in Tampa Bay, another one based in Charlotte, North Carolina, to really understand their secret sauce, what they've done, and then hopefully be able to learn enough where I can leapfrog the learning curve and, get, let's call it a decade and a half of experience within a few years. And I think if you pick your mentors the correct way, you pick the companies you work for the right way, and you really dive into those opportunities and bring out the full potential, I think you can really get a lot more experience if you spend time with people like that. So that's the approach I took. It works very well for me. Coming out of Florida State, I was helping lead acquisitions for a firm out of North Carolina. It was me and the founders of the company. Did that for a number of years. And right before COVID, I came back to my family's investment office as they were building up their real estate platform. And I helped them build that up even further, helped launch a senior housing platform. We had a few senior housing assets, but we really started getting on the gas again after COVID, create a lot of opportunities with, as you can imagine, COVID, was very, very tough on the senior housing business.
Oh
And
yeah.
there was a number of owners out there that needed to get out of those assets. So we were able to scoop up a number of properties across the country. It also helped us get into the LIHTC, low income housing tax credit space. We always have seen, with the portfolio of apartments we own and a lot of the assets that we look to purchase, that, rents continue to go up. Wages were kind of, they were going up, but they weren't increasing at the rate that, rents and housing costs were going up. So we saw there being a huge opportunity to focus on the workforce housing space, particularly the affordable housing space. And at the same time, there was a lot of money being put into the system through, different government programs and, companies expanding. So if we focused on, the major, MSAs, major cities, the Atlantas, the Norfolk, Virginias, those areas where there was a lot of people that were flocking to, we would be able to also, see increased rental increases, because rental increases for LIHTC properties are based upon area median income. So if you have a lot of jobs coming there, companies forming there with, higher salaries, it increases the area median income, which means our rents would go up. So we saw our rents increase from 10 to 15% annually over those couple of years, right? And that typically for LIHTC is 3%. So we saw a huge opportunity there, and then we saw an opportunity in the hotel to apartment conversion space. So I helped pioneer that for my family. We were one of the biggest converters in the country for a year and a half, 2 years. And then earlier this year, I founded a company with a close friend of mine that was helping lead investments for a large family office out of Tampa Bay. We started SP Venture Partners, and that's kind of where we are today. And SP Venture Partners focuses on making co-GP investments across the country with seasoned operators. And we also just launched a private lending platform where we provide first lien loans to real estate developers, real estate owner operators, and wealthy families that need liquidity and have assets for us to put a first lien loan on. So we've been building up these two platforms over the last several months. We're going to be focusing more on the private lending, I believe, over the next 12 to 24 months, just because of what's happened with banks and being like-minded with a lot of these real estate operators. We're able to kind of get a little bit more creative, understand kind of what these groups are willing to do, and we really look at them. They look at us as a partner. So we've been able to strike a number of deals across the country in that space, and we think that will continue to do so over the next 2 years.
Wow. So you've gone through a lot of change just in general, what you started with, the idea of being a surgeon. Why did you switch to this exactly? What inspired that change?
Yeah. So I think during 2008, I saw just how tough, life could get for a lot of different people. And, during that period of time, I thought, that's what really made me want to become a surgeon. I was like, okay, well, seeing my family's business still do well during that period of time, it made me see it as, kind of I won't call it a safety net, but kind of a safe harbor, for lack of a better words. It looked like an area that just always was consistent. It was always a good business to be in. But around that same time, there was a number, I don't want to get political, but a number of government programs, government legislature coming out that was just making it harder and harder to make sense of becoming a surgeon. I mean, if you go through schooling and you take out debt or pay money to go to these schools and to go through all that education, I mean, you don't get out of schooling until your mid 30s. You'll have spent hundreds of thousands, if not $1 million+ dollars, and maybe you have that in loans. There needs to be some financial incentive there, and that incentive is slowly eroding away. And the only way to make sense of it is just to continue working harder and harder, see more patients, build more clinics. it just was not something I wanted to do. I mean, don't get me wrong, I work very hard, but at the same time, if you're going to spend a lot of money towards a career, towards a craft, I believe there needs to be a financial reward for doing so. And I saw that erode away. I saw how that started to deteriorate my father's enthusiasm towards that craft. And just the combination of that just really just was, put a sour taste in my mouth. So I just gave it some real thought. I've always had a knack for numbers and for finance. So I like a lot of people, read a lot. I had the opportunity to work with a lot of different real estate operators, management companies. I think that really is what solidified it for me, just to kind of see that they were happy, they were doing well financially, they got to spend a lot of time with their families, they got to live enjoyable lives, and that's kind of what I wanted to do. Kind of saw my reflection there, and that's when I just said, all right, well, instead of just dipping my toes in, I'm going to go, fully in. I'm going to fully get myself involved in this and just focus on it. I mean, I'm young. I have a great family that was willing to support me, so I decided to go full in, and it's worked well. So I'm very happy.
Yeah, and I mean, there has to be just a massive change in maybe your own personal expectations of what your future holds, because I majored in music,
Yeah,
business technology. Was never interested in being a doctor of any sort,
yeah,
but from what I know, there's a lot of schooling involved, years and years and years of it. And all of a sudden, you're going from, okay, this is, you grew up around it. It was probably, you said it was a decision you had made, earlier on in life. And you probably had sort of planned for that amount of time to be spent in schooling. And then all of a sudden it's, okay, you're doing something now that doesn't require 10, 15 years of being in school and you know uh building your way up through that career. How was that, like, mental change of just suddenly you have different expectations about your own life?
yeah. That's a good question. I look at it as you have 10 to 15 years of formal schooling, or you just decide to go full bore into it and just
Yeah.
get experience just going through it. And again, you don't know what to expect. You don't know what you don't know, right? So
Yeah.
you're dealing with that. Maybe you go and you learn from a lot of different people, but you want to ask these in-depth questions, really get as much juice out of them, as much knowledge out of them as possible. But when you don't know what you don't know, you can ask those sophisticated questions. So it really is just getting yourself involved and just learning through grinding, just going through it, seeing what works, what doesn't work. When and you're going to have a lot of them. I've had a number of them already, and I'm sure I'll have a number of them, over my career. Is you'll have failures, and really taking those failures, I guess, kind of formulating a case study around kind of what happens, and then taking the good and bad from that. And if it's good, using some of that good to, in future decisions. The bad, making sure that's really burned into your brain, where you don't do the same, you don't do the same thing again. You don't want to replicate those. So I think a lot of it is, they call it the school of hard knocks, right? You get beat up a lot. And I think it sticks in my brain a lot more actually going out there, kind of figuring out myself. I mean, I've always had, a zest to learn. When I'm working out, I'm, watching YouTube or podcasts and kind of hearing other people's perspective towards things, and going to conferences, speaking at conferences. And I go to family office conferences, go to real estate conferences. I do a lot of different events just to kind of spend time with a lot of different entrepreneurs and people that are 30, 40, some of them 50 years my senior. I mean, I have some real estate partners that are in their mid 70s. I'm 27 years old, so they are almost 50 years older, which is just crazy, right? Being able to spend time with those people, picking their brains, seeing how they analyze things. I think that's what's been very beneficial for me, and that's what's allowed me to, I guess, embrace it, because you're like, oh, you have those aha moments every single day. So I guess I didn't think of it as much as, just once I started doing it, I was just so involved in it. I was learning little things here and there, and that was my education. So
And I mean, you definitely went to the School of Hard Knocks when it comes to going through those, those 3 months at a time internships. I mean, you're just taking in so much information all at once. I can only imagine.
Yeah.
Um, and you're learning not only from your own mistakes or failures, but probably from those of the people that you're working with and you're learning from, which can be just as helpful, if not more so.
Yeah, yeah, yeah. So exactly, and I mean, some of them I've seen, they've mentored me, and I even, since they've mentored me, I've seen them have a few failures here and there, and I'm still learning from some of those, and it's kind of, it confirms that, they're great, they've had successful careers, but they still trip up here and there, and that's what it is. Don't beat yourself up over it. Take time to digest it, understand it, and take the goods, the bads, and learn from it. So I'm continuing to learn. I mean, I spent numerous months with a lot of these different groups, but I still follow a lot of what they're doing and have a good relationship with most of the most of my mentors. So I have regular conversations with them, and we're all growing together. Again, they're several years, several decades ahead of me, but we're all still growing together.
Yeah, I mean, you hit on something that is something I talk a lot about on this show, and I love to bring up to the guests of this show, and that's the idea that you are learning more sometimes from failing than you are from succeeding. There's so much to take away from that, whether it's the good or the bad, and knowing how to handle that situation the next time it comes up. Because you're
Yeah,
right, you're never going to stop failing. That's
yeah,
life. It
yeah,
doesn't happen. It doesn't work that way. But the more it happens, the more prepared you are for the next time it happens. And it doesn't always need to be this, this massive, huge event that, can have years of ramifications possibly. Because if you already know how to handle it,
yeah,
it goes from really big to really small.
yeah, yeah, yeah. So I agree.
So moving forward, obviously you're in this new career path and you've done a lot of different things in it in a seemingly short period of time. Um, so moving forward, you mentioned that over the next 1 to 2 years, you're looking at really focusing on a debt fund. Do you want to talk a little bit about that and what that is?
Yeah. So one, in regard to the experience, experience at the end of the day is decisions. I've been very lucky to make a lot of major decisions in my, 8, 9 year career, right? I mean, I've helped, on the, I was one of the leading people that, general partners in the 25, 30 deals, right? Between myself and my partner, we've raised north of $150 million of equity from investors going to high net worth family offices, and it's helped us, just doing a lot of repetition is helped us really build up that experience and really help us leapfrog the learning curve. And then in terms of the debt funds, what we were seeing, I came from, my family's investment office. I decided to start my own firm earlier this year. My family owns over 5,000 apartments, and I was a large part of acquiring a lot of those. Dozen and a half senior living facilities, several hotels, storage. I was a part of a lot of that, and I still am involved in a certain capacity where I have a pulse on a lot of different markets. I have a pulse on a lot of different data points. That's really helped us guide our investment decision making. And one of the things I was seeing is just when you see interest rates double, triple, depending on what asset class. I mean, during COVID, your agency Fannie Freddie debt was under 3%. I mean, you were seeing some loans 2.6, 2.7% interest rates. I know we locked in on one deal at 2.99 and another one a little bit lower than that. Fannie and Freddie now is north of 6%. That's doubled, right? At the same time, you're seeing insurance costs that, over the last 3 years have doubled in almost every market. Some markets they've quadrupled. You're seeing payroll costs go up. Yeah, rents went up substantially over that period of time, but they're starting to slow down. The whole point I'm getting to is valuations have really gotten beat up over the last few years, and I still see strong legs in a lot of these different asset classes. But we're in a time where valuations, I believe, are going to continue to fall. So it's better to be positioned in the debt part of the capital stack. primarily the senior first lien debt. So you're there, you're not second fiddle to anyone.
Mm-hmm.
And it's a great opportunity when banks are being forced to really lessen their commercial real estate exposure, or they're putting in additional covenants into the loan. Let's just say, for example, they're going to issue a $10 million loan, and maybe they'll give you a pretty, attractive interest rate, fixed interest rate. Maybe it's comparable to Fannie Freddie, but they'll make you put several $1,000,000 into their bank, into deposit, and you have to keep it there. So it's like, okay, yeah, I'm getting 10 million, but I'm giving them 3 million, $4 million to put in the bank, or I have to maintain that. And if I don't maintain that, then that trips a loan covenant. The whole point is that you're seeing the whole lending get more and more restricted. So we saw a huge opportunity to work with real estate developers, to work with real estate owner operators, to work with, you'd be surprised, a lot of wealthy families out there that, just don't have the liquidity that they maybe used to have and are tied up in assets right now. And they know it's not the best time to sell assets, so they're holding on. But they're willing for someone to come in, provide them some liquidity by putting a first lien loan on, maybe it's a mansion in Beverly Hills, or maybe it's an industrial building in Atlanta. They have an asset where we can put that first lien on there. We don't go above 50% loan to value. Our interest rates are a little bit high, but they look at us and we look at them as partners. They know we're like-minded. We understand how to evaluate. We can close pretty quickly. We're seeing a lot of these opportunities out there. And at the same time, the family offices we've worked with, the ultra high net worth families, and the high net worth families, that accredited families, they're looking for a place to put their money over the next 6 to 24 months if they're not making those investments. And if they're able to get double-digit, cash flow, double-digit yield, which we pay out monthly, that's attractive for them. You're in a really good position. We require full personal recourse. So even if the asset has, issues, let's say it goes below our senior loan, then we have, recourse towards the borrower, and we have very, very in-depth due diligence on who we're lending to, the assets we're lending on. And they like that because we provide that transparency, provide what we're doing. That transparency leads to education. That education leads to confidence. And that's what's big. Our reporting, we do the monthly reporting. That gives them a sense of comfort. And at the same time, their money isn't just sitting, eroding away because of inflation or because of taxes. They're able to put that money out and earn a pretty attractive yield. So that's a platform that we're starting to build up. We're going to put together, we'll probably start with a $25, $50 million fund. We're already doing these deals on a deal by deal basis. And then, make a number of these loans, 6 to 24 month loans, and provide these attractive returns to these investors. At the same time, provide the very much needed liquidity to real estate investors and to, families that are just in a liquidity crunch.
Wow. So I think it's clear that you're, we talked a little bit before the show, and, we talked a little bit about how weird the last, 18 months have been, really, and how we don't necessarily know what it's going to look like going forward. But it sounds like, at the very least, you're taking advantage, and I don't mean that in a bad way, but you're taking advantage of that uncertainty, and you're saying, I'm going to provide people with the opportunity to do things that maybe they wouldn't otherwise be able to do given the current, situation.
Yeah. I mean, again, I think when you see huge problems, if you're able to provide a really attractive solution, and from the borrower perspective, we own a number of assets, right? I own a number of apartment buildings and senior housing communities. I understand how to value these assets. I understand some of the issues that they're facing. I'm not just some bank or some debt fund that doesn't have that experience, doesn't understand. I mean, I started in management. I know how to manage these assets. I know some of the issues they're dealing with. So I think for them, working with, a private lender that, can, is there, understands the issues they're dealing with, is, can be a little bit more flexible. It doesn't just have to go to an investment committee and say, oh, listen, these are, we can't, alter any of these. We're not flexible here. We're not flexible there. I do have that flexibility. But I'm also very cautious of, we look at what the collateral is. right? We want to make sure we have the right collateral, and we make sure, there are certain areas where we aren't flexible. We have to be first lien. We can't be second fill to anyone. We require the full recourse. But maybe we're able to do a loan for 6 months. Most people, their minimums are 9 months. Those little things are what allow a lot of these different investors and people in liquidity crunch to, it makes them feel more comfortable. And they also see us as a programmatic partner. So we're able to do a number of deals with these families, with these investment groups. So they don't have to, keep shopping and have that fear in the back of their mind that, oh, geez, this deal might fall through. Oh, we have SP Venture Partners. We've worked with them before. They're very reputable, have a good reputation. They've been able to perform before. We have something that's very similar to the last deal we did with them. And I know they're lending right now, and they're able to provide a solution to, the issue that, at hand.
And so given the general lack of liquidity that, obviously that's the problem that you're working on solving, are you noticing that people are sort of utilizing different avenues to find that funding for private lending, things such as Roth IRAs and, self-directed IRAs, 401ks, that kind of stuff? Have you noticed that being, maybe a trend?
Yeah. So I think when I have these conversations with these family offices, these ultra high net worth and high net worth families, I tell them, I say, listen, a lot of them do have Roth IRAs and they have big companies, or maybe they're executives at companies. They have these already set up. That's the preferred way to make these investments, because a lot of times these are shorter term investments. They're 6 to 24 months. So you're not going to be able to get the real estate depreciation that we would on some of the co-GP deals we do. So you're going to have to pay those taxes. But if you do it through a Roth IRA, you can alleviate those taxes, and you're able to get really, really strong yield. So I think it's a great place for them to put their money, and not just have it sitting there eroding away with inflation. So that is the preferred avenue for these families to make those allocations.
Yeah, I mean, it really does seem like it kind of just matches up perfectly with the general, ideology of both of those things and how they work in cohesion with each other.
Yeah.
But something else you mentioned is the extensive due diligence that you guys do.
Yeah.
And I think obviously that's always an important part of investing in general, but especially with what you guys are doing, can you speak to why that is such a focus for you guys?
Yeah. So starting in management, working for a number of experienced groups, I got to see what their checklist was on, with due diligence, both on, the groups they look to partner with, but also the assets they look to acquire or manage. So we always look for, our co-GP side is very similar to on the private lending side. Is we're looking at, first of all, who is that borrower, who is that group we're going to partner with, right? They're both partners. Whether it be the borrower or whether it be our co-GP partner, they're still partners. We're going to look at who they are. Are they going to have skin in the game? Do they have experience? What's their track record? What's their team? At the end of the day, when interest rates are low and everyone's having a good time, it's not hard to make money. So a lot of these groups that have been making money over the last couple of years, they got that false confidence. They weren't actually doing anything. Yeah, they were making investments, but the returns, the appreciation was more passive than it was actually active on their part. They weren't actually adding value. It was just because the markets were doing well. So we like to understand, what is their experience? Have they been through market cycles? Maybe they failed in prior companies? When someone fails in a prior company, especially if it's an entrepreneur, which they're on their second or third business, they have that sour taste in their mouth of what that felt like, and they have the taste in their mouth of what not to do. They're a lot of times able to make better decisions, because that's just not something that leaves your decision making. So we look for those groups that maybe have tripped up, understand why they've tripped up, what they have learned from there. So we go through a rigorous 5-step due diligence process. We start with one is, do they even fit our criteria? Is one. Two is we have them come down, and meet with us at our corporate office in Tampa Bay. We'll sit down with them, get to know them. Who are the main decision makers? Understand how their business works. And then, if that ends up going well, we'll go and spend time with them at their corporate headquarters. Go meet with them at their properties, or maybe go for lending, maybe go look at some of the sites that, they're developing on, or maybe it's, again, some of the other assets that they own. We'll go spend time with them, understand what those assets are like, get to know some of their other team members. And then after that, what we do is my partner and I will make a decision of, okay, is this a group that we're going to be looking to make an investment with or to lend with? We both have to agree on that. If we don't agree on that, if one of us says yes, one of us says no, we're just going to table it. So we both have to have a unanimous decision of this is something we're going to move forward with. And then after that, we'll end up making that investment or end up onboarding that co-GP partner to our platform. And then we go into, when we start looking at deals together, we have a full rigorous checklist of, if it's workforce housing, we won't go below a certain vintage. There's certain areas we will not invest in. There's certain structures. We have to be a co-GP partner. We're looking at doing lower leverage deals right now. We're not looking to do deals at 75-80% leverage. I mean, it's got to be a really attractive fire sale for us to use leverage of that sort. So we've built up this criteria, and why it's great for the investors that partner with us is we provide them full access to this criteria. Show them, like, this is how they've checked off all of these different categories. This is why this deal fits our platform. And that leads to transparency. And again, transparency leads to the education. Education leads to the comfort. When they're comfortable, then they're willing to continue to make investments with you. So that's what we've seen as our secret sauce has been our due diligence, and then showing our partners, breaking it down for them of this is why we're making this investment. It isn't just, oh my goodness, it's a senior housing deal we're buying at a discount, or a value add deal, because we can renovate the units. It's because it's located here, they're buying at this basis, it's structured the right way, and they have a track record of doing a dozen of these. We show them really that full picture, paint a full picture for them. When they feel comfortable with that, that's when they decide to make those investments with us.
Yeah, I mean, it's clear that you're just open and honest with them. And honestly, I can't think of a better way to start or, continue a relationship than that. Otherwise, there's not much of a relationship.
Mm-hmm.
But so before I ask you to plug yourself and tell the listeners where they can find you, I have one question that I ask everyone that comes on the show. And that is simply, what does financial freedom mean to you?
It's a great question. So financial freedom to me is, you hear a lot of people kind of say it this way, but I've seen a number of entrepreneurs be able to fulfill this. So it really is real when I look at it. It's be able to make your own decisions, be able to do what you enjoy. So I think one is the career you need to be in or the career you're in needs to be something you truly enjoy. I believe work is a fundamental part of life. So it's not just about traveling, doing all that. Maybe that's a part of your life, but being able to actually, provide and be productive. I think right now with, being an owner of affordable workforce housing, we're providing housing for people. So when you look at some of the issues plaguing our country and other countries, housing is one of those issues at the very top. I think there's 1 out of 5 families, or 20% of families in the U.S. are spending over 50% of their income towards housing. So when I'm able to provide that housing to them, at the same time provide attractive returns to my investors, provide attractive compensation for my company, myself, and my family, it's fulfilling. I think working in an industry or working a job where you're able to get that fulfillment, and then also still have the time to spend with your family and do some of your hobbies. I think that is what financial freedom is. It's not just the money side. It's also being able to find something that really provides that fulfillment. And that fulfillment is what makes you get up every day, be excited, and look forward to each and every day.
That's well said, and I couldn't agree more. So please, Peter, let the listeners know where they can find you, how they can get in contact with you, and anything else you'd like to plug.
Yeah. So you can reach out to myself or members of my company through our website, spventurepartners.com. You can also find myself, my partner Sean Coughlin on LinkedIn. We're pretty active on LinkedIn. So I think those are the two best areas to reach out to us. If you have any interest in, want more information about our company or our private lending fund, I know there's some contact sections on our website. So if you fill out those contact sections, we'll make sure to set up a time to meet and hopefully find a way where we can work together with some of your listeners.
Awesome. And that information will also be in the description of this episode for anyone that's interested. But Peter, thank you so much for coming on today. I loved hearing about your story, and I felt like I learned a lot from you today. So I'm very excited to see what you guys are going to do next. So thank you so much.
Michael, I appreciate your time. Thank you so much for having me on.
And as always, thanks for listening to The Road to Financial Freedom. If you enjoyed this show, please support the podcast by remembering to rate, review, and subscribe. You can keep up to date with us on Facebook or Instagram at Road to Financial Freedom Podcast. Thanks again, and I'll see you next time. If you like what you're hearing on The Road to Financial Freedom and want to learn more about self-directed IRAs and 401ks, click the link in the description to download a free toolkit with everything you need to get started.